Welcome back to First Move, and returning once more to our top story today. A Fed interest rate cut in September has gone from probable to a near certainty after Friday's weaker than expected jobs report. The Fed coming under fire for not reducing rates at its meeting this week after the just released July jobs report undershot expectations by a wide margin. In addition to Wall Street's losses, European stocks also suffered, Germany leading the decline, down over 2.25%. And if that was bad, Asia was worse. We saw sizable losses across the board, with the Nikkei down almost 6%. The Japanese Topix has also had its worst day in 8 years. And it wasn't just stocks, actually. US bond yields fell to their lowest point this year, and oil prices tumbled on slower growth fears too. Let's get some context. Joining us now, Jason Schenker is the president and chief economist of Prestige Economics. Jason, welcome to the show. The Fed will have seen this data before they made the decision on interest rates. They have a pretty good sense of what's going on in the economy. Did they mess up this week by not cutting rates?
Thanks for having me on, Julia. I don't think they made a mistake. They knew the data was here, and the Fed Chair Powell, in his press conference, repeatedly stressed that they're looking at the totality of the data. And the top priority for them has been inflation. They did acknowledge in the statement this week and in the press conference that now there are sort of two-tailed risks, both from inflation and also downside to the labor market. They're watching these data points very closely. They are data dependent. And I think going forward, they're going to be watching every release before they make their September decision.
If we look at this number, it was weaker than expected, but we're still net adding jobs. The unemployment rate rose, but a lot of that is because more people are coming into the jobs market. The challenge is just making sure that there are jobs available for those people to go to. I sort of take a step back and I look at the number of analysts that came out saying they need to cut rates by 1 percentage point this year, perhaps even more. Some people talking about a rate cut before the next meeting. And I just wonder what the panic is.
Well, I think these are really good questions. I think the first piece is that an intermeeting cut would take something more significant than a jobs report where you saw a net gain in payrolls. This was still a positive jobs report in that respect. We are now at a record all-time high for payrolls. We are at a record all-time high for the labor market. And in fact, if you look at the 3-month average of payrolls, that actually accelerated this month. The 3-month average actually went up. So to say that this is catastrophic is a little bit too far. But I think what analysts are worried about is that this is the camel's nose under the tent, and there's a lot more to come. Against that, right, the idea that there's never just one cockroach, that there's going to be more bad jobs data to come. There's also the idea that one report does not a trend make. And so we're going to be watching that next jobs report more closely than ever to see if this is the outlier or if this is the trend and if things are going to get worse. And of course, unfortunately, this report came after yesterday's ISM manufacturing index, which took a really big drop. And that's data that the Fed did not have in front of them.
Yeah.
But still, right now, inflation is elevated. And this still was a modest number of positive job gains.
Yeah, and I think if you take some of the sort of flapping and the panic out of what we felt today, which had other sort of market reasons perhaps, you could also argue it's not going to hurt to take interest rates down to 4% if you want to just sort of maintain and support what we're looking at least at this stage, as a soft landing. But no one should be talking about sort of recession risks, imminent recession risks today. Is that correct?
Well, I think knowing that the risks are rising is important. There's this thing called the SOM rule, where if the unemployment rate goes up more than 0.5% in a year, it's a signal of recession. The same thing is true if we look at the ISM, where below 50 for a period of time is a signal of recession. But that's been weak for a while. And so you have now 2 data points, 2 days in a row that could mean a recession is brewing, but we're coming out of very exceptional times. And so this might be one of those times where that rule also finds an exception. It doesn't mean there's not risk. It doesn't mean a recession couldn't happen, but we still have about 8.2 million open jobs as of the month of June, and jobless claims are below 1.9 million. So considering the totality of the data, the Fed is probably still going to be a little bit worried about inflation. By the way, if the market freaks out by the fact that this report is whatever 60, 70,000 fewer jobs than expected, it's not a big delta, right? Imagine if this had been a negative number, what would have happened, right? But this wasn't negative. It was still a positive addition, but rate cuts are coming. And if the data gets worse, we will see more rate cuts than expected.
And they're watching it closely. And I will just add, Claudia San on that rule was asked, and she even said, look, she doesn't see recession risks at this moment. And Jay Powell was asked about it, and he said it's, something to watch versus being a rule. So we've tied a bow on that. I was going to ask you about black jobs and employment, but we've run out of time, so I'm going to save it till next time. Jason, great to have you on, and have a fantastic weekend. So thank you.